Yeah, that's a very interesting question. I think part of the challenge with answering that is that actually the position of the regulator is unclear at present. There's been a lot of discussion, consultation papers, etc., Karen, and I think what you'll find is that gradually over time the picture will become a little bit clearer. What we're definitely seeing is a much greater demand by the regulator for transparency into the actual cost of research, the value it brings, not just to an individual asset manager, but potentially to each of their clients or each of their funds, which is very significant. That's often been overlooked in the past. And really what we're seeing our clients doing is actually very accurately trying to estimate the value that the research brings to their business. So that could be actually published research papers that they subscribe to. It could be actually corporate access to boards and the organizations themselves. It could be time with analysts from potentially a brokerage firm to help them make the right investment decision. And rather than bundle that all up in one sort of notional price, firms are really structuring the analysis and saying, well, this is worth £1,000 and this is worth £5,000, and budgeting that over the year. And then what happens is, as they are paying for that research via their trading commissions, they need to very accurately track that during the year. So if a client has to cover £50,000 worth of research value up front, they need to track that by paying research commissions on the trading activity until they reach that limit, and then dropping down to only pay execution only after that point for trading activity for the rest of the year. So we've actually developed additional functionality in our products to allow firms to track that, not just for the entire firm, but for each of their underlying client portfolios, including the fact that different geographies may have different targets, because you may be paying for research in the US from one firm and the UK from the same firm, but have different targets and budgets depending on where your clients are. So that ongoing tracking and reporting functionality is very important, and as I said, that's now integrated as part of our process, and appears to be very successfully meeting the demands of our trading clients. Yeah, I think the potential, obviously, if the regulators go the full 9 yards, as it were, the whole hog is actually hard unbundling. So that's where you cannot use any soft commissions to pay for research. Essentially, you have to write a check. So if you want research from an investment bank, you have to pay for it in hard cash by the asset manager. That will actually impact some of our clients' businesses, because for some clients, they will actually employ their own analysts in-house and actually start conducting their own research. It obviously better supports the independent research houses that are actually able to specialise in particular sectors and particular markets and provide very high quality research. So that model may actually become more prevalent, possibly at the expense of the big investment banks that may have to adapt their models and their charging models in order to provide an equivalent level of service. And really it becomes a market forces driven decision as to what the best route to go down is for individual asset managers. Yeah, at the moment it's very much an equity problem. The reason being that the market infrastructure for equities is more complex. Post MiFID I, obviously the markets are fragmented, the same instruments are traded on many different exchanges. The complexities of actually achieving best execution and paying for research, potentially breaking an order across a number of brokers are much more prevalent. And in the equity world, the trading commission is actually explicit from the overall price that you're getting from the broker. So it's much easier to track the equity commissions, and therefore it's easier for the regulator to shine their spotlight on the equity trading commissions. The reality is other asset classes such as fixed income and FX, the all-in price that you're quoted includes the commission from the counterparty, and it's not necessarily explicit exactly how much of that represents commission that can be paid for research. So I think, much in keeping with other regulation, the regulator will gradually spread out and focus on other asset classes, particularly fixed income and foreign exchange, where the market infrastructure is gradually becoming, supporting more electronic trading, becoming more complex, and I think that's certainly an area the regulator will be looking at in more detail in the future.